everyone, welcome to Module 10 of the Build a Profile course. What is Forex and how to trade it? As a reminder, trading involves substantial risk of loss, is not suitable for all investors. Past performance is not necessarily indicative of future results. So here's the objective of this module is to describe what is Forex and how can you incorporate it into your trading and investing. Well, we're going to start with, similar to other products, talking about benefits and risk of Forex. So some of the benefits. One is leverage. So similar to options and futures, there's the ability to use a more efficient use of your capital through the expression of leverage. It doesn't require as much dollars to open. In fact, you can have some Forex accounts that are under $500 to get started, and you can trade very small, as you'll see why here in a second. They offer the time frame opportunities that you would see in futures markets, and that there's 24/6 that these markets trade because currency is exchanged across. And if you haven't picked that up, Forex is foreign exchange, so it's the relationship between two different currencies. But that's one of the benefits. So if you have a day job, you can work your day job and then you can trade Forex at night if you want. Many times they are offered as a commission-free trade, so the brokerage is still getting paid. They're just getting paid between the spread between the bid and the ask, but they can be a very cheap way to trade, so you're having a lot of business cost as a result of trying to trade these products. And there's product diversity. There's so many currencies in the world that all are paired against each other, so they provide all kinds of unique and interesting opportunities to express an opinion. And they're very liquid, meaning that if you're in a position you want to get out, there's often a buyer for a seller and a seller for a buyer. So they're very liquid products, all key benefits. Now, risk. Just like leverage is a benefit, leverage is also a risk. And we're going to spend a little bit more time speaking about this specifically, so keep that on your radar. Geopolitical risk. Because these are currencies and because these are tied very tightly to what's happening in the relationship between one country to another, geopolitical risk impacts Forex more than any other product that you can trade. So you'll often find that Forex traders are far more attuned to what's happening globally than an equity trader or even a futures trader. Central bank risk. This is tied to the geopolitical risk. It's a component of that, a facet of it. But you have central banks in almost every world economy who are trying to do two things. They're trying to look at unemployment, they're trying to look at inflation. The way that they're looking at that is their monetary policy. So central banks are often making decisions around interest rates and other things that impact their currencies in relationship to other countries to establish trade benefits and give themselves an opportunity to do well in global trade. So central bank risk can hit you. You can wake up one day and a central bank makes a decision and you will see wild moves happen in these currency pairs based on who wins and who loses. Learning curve. There's a pretty decent learning curve to trading Forex and understanding which pairs are going to be the best mix for you. They all, just like stocks and futures, every trading product has a personality of its own, and so you'll have to learn which one fits you best. We're going to look at some popular Forex pairs, but it does have a learning curve to it. Those are the benefits and risks. Let's talk a little bit more about the leverage. So most currency pairs are actually, they're the least volatile of any trading instrument, which is funny because you'll hear stories of people absolutely blowing up their account trading Forex. The reason why is not because Forex itself is that volatile, but it's because the leverage that people put on in order to trade these products. So, for example, in retail Forex market, leverage can be as much as 250 to 1. So if I have two currencies and they're moving a penny between each other, I mean, that's not such a big deal. If I'm dollar versus a dollar or a dollar versus a euro. But if I'm leveraged 250 to 1, a penny increment means something different. It becomes $250. It can be significant. So while it is the most or least volatile financial market around, the leverage makes up for it. And the amount of leverage differs depending on the type of the account. The often used factor is 50 to 1 and then some are as 250 to 1. So just to give you, again, an idea, a factor of 51 means that for every dollar you have in your account, you control up to $50. So when you talk about leverage, it's always talking about what are you controlling. And the brokerage is giving you the opportunity to control more than what you actually have in your account. Again, this could be an effective means of capital use, an efficient use of capital to express risk in the markets, but just as it's an opportunity for gain, can also be a significant opportunity for loss. But for example, if you have $1,000 in your account, the broker will lend you $50,000 to trade in the market. So this leverage also makes your margin, or the amount that you have to have in the account to trade a certain amount, very low. So in equities, margin is at least 50%, but when you have 50 to 1 leverage, it's 2%. So to trade $50,000, you just need 2% of that in your account to be able to have that type of leverage. So can be an efficient use of capital, but can also be risky. Be aware, just be aware. Let's talk about lots. So whenever you trade Forex, you trade these pairs in lots, and depending on the leverage, you'll see what they get. But there's a standard lot, which is 100,000 units of any currency. A mini lot is 10,000. A micro lot is 1,000 units. So a 1 pip movement for a standard lot corresponds with a $10 change. So if you buy $100,000 against the yen at a rate of yen 110, and the exchange rate moves 110.5, which is a 50 pip move, you make $500. And if it falls 50 pips, you lose $500. Now, what exactly is a pip? What is a pip? Because in Forex, you're going to talk a lot about pips. In stocks, we talk about dollars and cents. In futures, we talk about ticks. In options, we talk about dollars and cents and ticks. In Forex, we talk about pips. So one of the ways you can easily identify if somebody's a Forex trader is they'll say, I made 20 pips or 18 pips. But a pip is a point in percentage. So it's what you would consider a point for calculating profits and loss. But when, for example, when you're trading a mini lot, which is 10,000 units of currency, each pip is worth roughly 1 unit of the currency which your account is denominated. If your account is denominated in USD, for example, each pip is worth about $1. In all pairs involving the Japanese yen, a pip is the 1/100th place, or 2 places to the right of the decimal. Although currency pairs, a pip is the 1/10,000th place, 4 places to the right of the decimal. But a pip is the standard measurement for point in percentage. So just to make this a little more realistic, if we want to get an idea for what this looks like, okay? So you can go over here to investing.com and let's look at Euro USD, and let's look at what's Euro. We're going to add. So this is the Euro paired against the dollar. We're going to look and see where this has been trading recently. Let's look on a daily chart. So let's say back in December, let's say you had it at $1 or 1.2. Okay, so we're going to if you're in that position and you had a mini lot on and you had just bought 1, then you would have $372 in profit. So you can use this tool to kind of fudge with, you can get an idea for what these different products are like. So say, for example, you go in and you want to say, all right, I bought a large lot at a 1/50 leverage. You can see the difference. So mini lot versus a standard lot. Same trade, same degree of leverage, very different outcome. in that trade. But these move in pips. Okay, so let's look at some popular pairs that are traded as you're building your watch list and looking for opportunities within Forex. So here at the top, and this is what we call a spot Forex market. So you have the euro versus the US dollar, you have the British pound versus the US dollar over the yen, the US dollar over the Swiss franc, which is the CHF, the Aussie dollar over the US dollar, the euro over the pound, the US dollar over the Canadian dollar, the loonie as they call it, the New Zealand dollar over the US dollar, the euro over the yen, and the pound over the yen. Now these are just some of the popular pairs that are there. I would say if you're going to start with a list, I would start with these. You could find lots of resources and references to these Forex pairs. You can see actually that there are far more pairs available, and some that are even starting to include, and we'll want to highlight these, pairs with cryptocurrencies. So this is Bitcoin versus the US dollar, Bitcoin versus Ethereum, or Bitcoin versus the euro, and then Ethereum versus the US dollar. So we're starting to see, as the cryptocurrencies gain notoriety, that they fall within the category of foreign exchange. And I want to speak about this for just a second, because while this is a fantastic instrument for trading and expressing opinion and risk, this is not the same as buying a stock. So if you go back to module 1, we think about the idea of being an investor versus a trader. Forex is a fantastic market for the trader. If you're an investor who wants to have a position on and hold it for some period of time, manage that position, adjust that position, Forex is not for you. And I have lots of friends that I've run across. Part of the motivation for even building the Build a Profile course was that they were saying, hey, I'm going to buy Bitcoin, I'm going to buy Litecoin, I'm going to buy Ethereum, and but they're speaking about it as if it's the next big stock, and it's not. It fundamentally is not that. And because of the leverage, and because you have instruments that can go in either direction, you can compound your losses. So if you're trading a stock, you buy the stock, what's the most that you can lose? You can lose what you paid for that share if that company goes bankrupt. In Forex, you can actually lose far more than you actually put up initially, because these currency, they're pairs, so they can work. Both of them can be moving in a different direction that can exacerbate the pain. So be aware of that. Again, fantastic instruments to trade, offer lots of opportunities for people who want to trade, not great for investment or holding. You're looking for short-term positions, or as some often use them, say for example you are a producer of a commodity, you can use Forex as a way to hedge your position if you trade or export that to a different country. Now, when I think about Forex, I don't often trade the spot Forex. I actually trade currency futures. So one of the benefits of looking at futures is, and we talked about this, we talked briefly about this in the futures module about how you can trade currencies, but you can actually express risk against other global currencies by keeping it stated in US dollars. So when I look for opportunities, for example, let's say, for example, we're going to look at the Euro USD. So this is the Euro over, it's stated in US dollars. You can see it's traded at 123.76. So I've got a 30-minute chart here. All this is just a 30-minute chart, and these are a couple moving averages is all this is. This is a 5-minute chart with some moving averages. Only benefit to use moving averages is just to help smooth price action. It can help you discern a general direction that the market's going when you're having all this movement back and forth. There's a value there. But here's the Euro USD. So you'll notice there's no volume data present because it doesn't record volume in Forex. But if I do the 6E, okay, the chart will actually look, the candlestick chart looks the exact same. However, I get now volume data that I can use in profile. So I believe I have an edge over other Forex traders because I can use the profile as a place to express opinion. So for example, right now, I see a number of areas in this chart. Right here, there's a lot of volume right up here. So this is about 124. And then we've also got a big volume node here at 122.80. And I would like to see if the euro could move up here, reject off of it, and then auction back down to 122.80. That's an interesting trade for me. Now I can see that using the Forex futures. If I go back again to the spot, I don't see that. And you'll find a lot of retail Forex traders who are incessantly tied to markets because they can't tell the value of one price versus another. And when you look at markets like this, there's nothing to distinguish who that price is more significant than another price. They're just moving, and you're looking for movement back and cross and trying to take out different levels. You're doing stuff like, oh, here's a pivot point, so if I can get above that, well, then if I could get above this area, you can kind of discern areas where you're doing some balance, this rest, when we talked about the four behaviors. But in terms of what we saw in the futures was to look for this zone of price, and it actually gave us a good price, and then an area down here to target for a rotation lower, which we could see that clearly. We can't see that as clearly if we're just trading the spots. I always prefer to trade the Forex futures. This is another one that was a benefit, especially around the Bitcoin craze. Okay, this is Bitcoin futures, so it allows me to actually trade Bitcoin but not convert my currency into Bitcoin. I can stay in US dollars. So this is a fantastic way to express risk on some of these currency pairs while looking at the futures. Now, there's some interesting dynamics around this. So futures are always stated in US dollars. So when you have a pair, we're going to go back here to our pairs. When you have a primary pair that's not stated in US dollars. So for example, let's look at the Canadian dollar versus the US dollar. So USD over CAD is the pair, but the future is stated in US dollars. So when I go here and I look at the USD over the CAD spot, okay, look at this chart and look at this profile. Now we're going to look at the Forex future. It's going to be inverted. It's because rather than being stated in Canadian dollar terms, the pair is stated in US dollar terms. So you can still do the same thing, you just have to invert the chart. The same thing is true with dollar yen. So where it's USD over JPY, which looks like this, if I want to trade it from the future side, I trade the 6J. So I can see same things around risk or areas, and what I actually do is I'll use the Forex chart or the futures chart to trigger the entries on the inverse and the spot. So that's how you find opportunities. And in Forex, the opportunities are directional. So we're always looking for places of directional risk that we can express opinions on and do that. It's something that we can do profiling. So we use the profile to help us determine opportunities in futures. Now, one other thing that I'll say about these is, say, for example, I have a pair and say I don't want to trade the futures. You can see here, this is a TPO chart. So while you can't get volume data in Forex pairs, you can get time data, which can approximate where the volume is. So if I look at this chart, you can see that on the yen, there's an area here where we've spent a lot of time. Okay, so if the yen moved higher, this is an area of significant resistance. We'd expect the yen to pause down here. And we actually have a level here that's above us that would be a reference point. We have a level here that would be a reference point. So we can use profiling, specifically time-based profiling in Forex as a key advantage. This stuff works in every market. Profiling, although profiling originated in futures markets, is beneficial in trading stocks and Forex. So again, they can be directional. Forex is optional, although given the leverage, I would say just stay with the spot. Don't worry about trying to make it more complex by putting options around that. You can use the TPO charts for spot Forex and volume profile for Forex futures. Very, very effective in helping find opportunities. Okay, homework. So go back, look at the list of the Forex pairs, add them into a portfolio. You can watch a review price, and if you have access to profiling software where you can look at either the time profiling or the volume profiling to try to identify key levels of interest and make decisions, make directional decisions based on what we talked about in the prior modules about being able to answer the 4 questions before putting on a trade, and review your performance. Review this video, complete the homework, proceed to the next module. If you have any hangups or questions, send me an email, give me a call, we'll get you set up. If you want to look more at Forex specifically, so again, this whole course is meant to give you an overview of these products. Investopedia remains a great resource for just learning the terms. You can understand more about pips and how that's all calculated. Forex Factory is a great resource to be able to find lots of economic data, central bank data, and news as it pertains to the specific Forex pairs. Investing.com, again, is also a great reference, and you can actually practice putting on positions to see based on the different leverage and size, just so that you're starting to get comfortable with what does a move mean? How much is that going to impact me as I'm looking for opportunities? That's Module 10, what is Forex and how to trade it.